Welcome back to Bitcoin Advisors. My name is Chris, bringing it to you here from Westlake Village, California. It is a bright and beautiful Thursday afternoon. And what do we do here? We usually cover Bitcoin's price action, traditional markets, gold, silver, and the dollar, some of our favorite altcoins. But today, going to be a little bit of a different video, and I've got some really powerful information that we're basically going to go over Jerome Powell's remarks on interest rates, tapering. We're going to go over the Evergrand situation, and we're going to take a look at how that is going to impact traditional markets. As you probably already know, Bitcoin is highly correlated with traditional markets like the NASDAQ, S&P, and the Dow Jones. So let's dive in. And don't forget to give me a like and a subscribe if you enjoy the information here. All right. So what did the Fed say yesterday? The Federal Open Market Committee left interest rates unchanged yesterday at their meeting, which was largely expected. So how is this going to impact the markets? And I'm just going to read you a little snippet from their statement yesterday, quoting Powell saying, "If progress continues broadly as expected, the committee judges that a moderation in the pace of asset purchases may soon be warranted." Now, they did not indicate exactly when this reduction in asset purchases would commence, so no specific timeline of tapering yet, but a gradual tapering process that concludes around the middle of next year, likely. Yeah, so what they're doing is setting the stage for a December announcement. And Chair Powell was asked in the press conference what he would need to see. What would he need to see to start the taper? And he said, well, we've made substantial further progress, which is their definition on inflation on that front. And they said more than substantial, but we've not made it fully on the employment front. And what he deemed would be necessary for them to check the box and start the taper, the employment report that came in last month needs to be much, much better. It was a huge disappointment. Unemployment claims around 223,000. So are more people going to go back to work? If so, I think the taper could start early next year, but there is a lot of headwinds. They could push it off, kick the can down the road. But even assuming that they move ahead with a $15 billion a month taper in December, let's call it through July of 2022. That period is still going to be incredibly accommodative. There's an incredible amount of liquidity still going to be in the system during the taper. And just to give an idea, the bond purchases, while they're reducing at $15 billion a month, over that 8-month period, will be at about $450 billion. And then you have another $200 billion of interest and principal reinvestment. So that takes you up to $650 to $660 billion of additional liquidity during the taper period, which is actually larger than the entire sum of QE2, which was $600 billion. So for people thinking for 1 minute, tapering starts and the punch bowl is gone, I think that couldn't be farther from the truth. That liquidity is going to be there for some time. And then rates, he made it very, very clear distinction that it's a completely different decision process. And when the taper is finished, it does not mean that rate rises start right away. So do the markets realize this? And let's take a look at the market action today, and we'll just pop right in there and take a look at the S&P 500, which is the one I am keeping a close eye on. S&P getting a big bounce here. I might as well put the graph on for you so you can take a look. So the S&P getting a big bounce. Let's measure this bounce. So 3% bounce. Almost negating the entire correction right away. What about Bitcoin? Getting a big bounce, and we'll be going over Bitcoin's price action towards the end of this video. What happened to gold? What are my golds doing? Gold getting absolutely shellacked back down to 1750. And I would imagine we test somewhere around the bottom side of this range at some point. That I would be looking at as a major buying opportunity. Again, not financial advice, but I'll get into as to why I think gold might be something to keep an eye on. And so what we're seeing here is a risk on move. The markets, they're kind of digesting the news and playing into the bounce. And in that context, I do think the 10-year yield rises into the end of this year, maybe towards Q1, but we're getting in the neighborhood of 175 basis points, maybe even 2 or above 2% on the 10-year yield. And in that type of environment, what we're going to see is a dramatic outperformance of value cyclicals reopening relative to tech and growth. So this summer when yields were down, tech and growth came back. The ratio, the value stock performance to growth stock performance hit a low not seen since before the election last year. And so the Fed chairs are split down the middle. It's 9 members do not see a rate rise in 2022, and 9 members do see a rate rise in 2022. So in general, I think the market was pleased to see the taper was delayed till the earliest November, December, more likely first quarter of next year. And really, they are setting the stage that these are 2 distinct actions. The earliest you're going to see a rate rise would be the end of 2022 or more likely 2023. And the reason you saw that split come about is because, well, they did take their GDP estimates down for 2022. They took their unemployment expectation up from end of year 4.5% to 4.8%. We're at 5.2% right now. Unemployment, 5.2% unemployment right now. So, and their inflation expectations have gone up dramatically from 3.4% to 4.2%. And for this year's end, with inflation expectations having been taken up, it's natural that more members would say, yeah, I see us raising rates a little sooner, like next year. However, Powell's base case, if it's correct that inflation is transitory due to supply chain bottlenecks, and that gets worked out over time, and wage inflation, that gets worked out as labor comes back into supply. And now that some of the extended unemployment benefits have rolled off and childcare is available with more and more kids going back to school, I would say more and more kids going back to school. If he's right about those 2 things, then there would be no reason to raise rates, and he did allude to that. Now, if inflation does normalize, so it's going to be a function of inflation, but with them taking inflation expectations up, kind of against Powell's expectations that it's just transitory, it's natural to see more of these members think there's going to be a rate rise next year. Why? Because how do you fight inflation? You got to raise rates. Powell did indicate yesterday that their inflation target has been already met. I don't think they're going to need inflation to get much higher for them to take action. However, Powell's main priority is full employment. So there are 2 things, and the key word that he's consistently used while their short-term target has been met, and he will let it run hot above 2%, inflation above 2% for some time in an effort to meet full employment, which is his top priority. And just to put that into context, what does full employment mean? Well, in February 2020, before the pandemic, the unemployment rate was 3.5%. Now it's 5.2%. They're expecting it to be at 4.8% by the end of the year. So there's a lot of room there, right? There are 8.4 million people unemployed today. February 2020, right before the pandemic, there was 5.7 million people unemployed. So you're talking about 3 million people that he still wants to get back to work by the end of this year. And I tell you what, the labor market is soft. I think people are still sitting on their couches, not really looking for jobs. And they're sitting on all that money they invested in Bitcoin They took their unemployment checks, they threw it in some Bitcoin and some altcoins, and now they're just relaxing, eating pizza. But forget what I say. That's that's just a joke. All right. So, but the reason they want the unemployment to come back, if it doesn't, you'll have long-term structural unemployment that we saw for many years following the great financial crisis. And Powell said he's willing to avoid that at all costs. And the cost he's currently paying is the risk of runaway inflation, which he believes won't happen and is in fact transitory. Good for Bitcoin. Now, let's bring up Evergrand because that was the headline over the past several trading days. Now, the markets, again, they've rebounded fairly nicely here today. And if we take a look back at NASDAQ, which has been the general of this market, we are getting back above that area that we wanted to see a daily closure. I mean, really, we got to get about 15,500 to kind of reverse or, create a higher high on the daily time frame. So Evergrand. Why is the market rebounding today? Partly on news of the Fed and partly on news that the Fed. Sorry, I'm losing my train of thought here, guys. So yeah, again, market's up again this morning. And so my question to everybody is, do you think the markets are just sort of shrugging off any risk from China? China too big to fail? Well, Evergrand, I'll tell you what, it's been a slow motion train wreck since last July. The stock is down 90% in 14 months. So if anything was telegraphed by that, it was the demise of Evergrand. And a publication was released yesterday that was a deal was in the works with the Chinese Communist Party. They're going to restructure Evergrand into 3 separate entities. And the markets really like that idea. So the whole story here is this. Number one, the Chinese government is now going to loosen its monetary policy. So that's good news. But the real key that everybody's been waiting for, because China was one of the first to tighten coming out of the COVID, right? They tightened far too early. You've seen it in their economic data. What they did 6 months ago has caught up with them with the tightening and the zero COVID policy. And you've seen weaker and weaker in numbers. So a lot of the managers, they're looking for what would be the catalyst for China to start to ease. And yes, indeed, we saw it. It was Evergrand. The central bank injected $14 billion into the system 2 nights ago. And the number one key, and also they kept their 1-year and 5-year loan prime rates steady. So now, because of Evergrand and because of the situation, the Chinese government, the Chinese Bank of Japan, Bank of China, they're expected to initiate rate cuts starting next month. And if that's the case, the negative story surrounding Evergrand is actually going to be a very positive thing for, I think, Chinese equities moving forward at this catalyst and for U.S. equities and even for Bitcoin. If this is the catalyst that gets them to move ahead with easing and accommodative monetary policy, which they've neglected over the past 6 months. This could turn out to be a tremendous positive as we work through the next couple of days and weeks. And again, there's going to be some bumps along the way, but if it forces them into action, right? They called it a black swan event. I'd call it a white swan. I'd say it'd be very, very good if China starts to get on the printing press starts to go burr, right? Okay, finally, U.S. equities. A lot of people talking about overvaluation. Sorry. A lot of people talking about the stock market being absolutely overvalued and a 10 to 20% correction just because of these overvaluations. They're so overstretched. And I would say this. I would say what we would need to see for that to happen, a 20% correction, we need a recession, right? We need the yield curve inversion. And these things just aren't popping up on the radar right now. If you take a look at what we can look at from this chart in the S&P. Here's what I would say is the most bearish thing. We got the first lower low on the daily time frame since coronavirus dump time. Now, if we put in another lower high here, that's going to be a downtrend on the daily, and you can expect lower lows. I don't know if we get down to 20%, but you know what to do until you get a trend reversal, right? So, but we did have 6 banks that came out over the last week and said, hey, look, we're looking for a 10 to 20% correction. I'd say it's a little premature. Why? You're going to have to buy the dippers. They're coming in right now with a vengeance right here. That's number one. Well, that's the first reason. Number 2, credit spreads. They've tightened. After they were blown out last year, once they've come back together, that's usually a multi-year process before we get another yield curve inversion. So a 3 to 5% correction, that's normal. And with the Fed, China easing, with the Fed looking to kick the taper tantrum down the road, I'd say we're at the beginning of the process. I would call this a tremor before the earthquake. And I would say that we don't get a major pullback unless we have some sort of recession or global lockdown, maybe the next year when the taper starts and when the Fed is starting to take the punch bowl away, maybe the beginning of next year. You could get that nice 10, 12% correction, scare everybody. But to get a 20% correction, everyone's talking about it. Major banks, they've been calling for it. It's probably premature and will require a recession. And that would absolutely shellac this whole recovery from COVID. I mean, to give you an idea, the S&P 500 would come down for a 20% correction down to about $3,500. That is a big, big washout. And, the conditions just aren't there at the moment, the underlying conditions. So the Fed also projected GDP to go down to 5.9% due to the Delta, and that's down from 7%. And next year they have GDP pegged at 3.8%, which is still above the trend. So you have to consider, with all the money supply expansion approaching $5 trillion, plus you're going to get another $1 to $3 trillion in infrastructure and social spending when we don't even need it, right? Whether you want it or not, it's coming, right? Whether you voted for it or not, it's coming. And we're just living in a world of liquidity. Corporate buybacks are at $760 billion and rising. Earning estimates are continuing to go up. And as we work through the labor and supply chain issues, you've also got, $4.5 trillion in money market funds just sitting on the sidelines. And pre-pandemic, there was $3 trillion. So there's another $1.5 trillion sitting in money market funds, losing purchasing power due to inflation. And that money's going to have to make its way into risk assets, or they're going to lose their purchasing power. And I'd say that's definitely bullish for Bitcoin, sideways and up for stocks. Another question I've been getting is, how likely do you think another global shutdown will be? And I think, frankly, it's 0 probability. People just won't have it. There'll be riots in the streets. There'll be people going absolutely crazy. I will not have another lockdown, okay? You have 6 billion vaccines out there distributed globally. Most people, if you had the vaccine, you won't end up in the hospital because COVID, right? COVID won't kill you, but maybe because of a bad reaction, your finger might fall off. You might get a seizure. I don't know what the whole vaccine thing is going to do to your body in general, but apparently you won't get sick from COVID. So most people, right, they want to get out. They want to put their masks on. They're going to do what they have to do to get back out there. But hey, it's not what the people want. It is what the government wants. And how quickly did they strip our basic rights away last year? So what is the solution? You know the answer. Buy some Bitcoin. There's only 21 million. Do you own one? I'll leave you with that. Hope you all have a blessed day. Take care, and we'll see you next time.